Hello, viewers, and welcome to another edition of SS Insights Company Watch. I'm joined by Justin Peters, Executive Chairman of Leigh Creek Energy. Thank you for joining us, Justin.
Great, thanks, Matt. Good morning.
Can you update us on how the project at Leigh Creek is going?
Yep, certainly. We've been working out at Leigh Creek now for 5 years. We started the process with a fairly tough regulatory process with the South Australian government from 2015, and we were able to get the demonstration plant up and running last year. So we actually started gasifying near Christmas 2019, and we ran that plant for about 3 months. Went very successfully. We were happy with the gas, we were happy with what we produced. And the reason we had to go through that process was we had to show several things. One of them, we had to show to our investors that we were capable of doing it, that we had the capacity within the company to be able to actually gasify. We had to be able to show our strategic partners in China what the quality of that gas was and what it was made of, so they could work out a product mix that would work from that. And we also had to show the South Australian government that we could do it safely, that we could do it in an environmentally sustainable and friendly way. And then we had to show the government also that we could actually extinguish that, put it out, and monitor it from there on, which is what we've been doing. So on a monthly basis, we have to provide monitoring results to the South Australian government for air, noise, water quality, soil, subsidence, all that issues. Each one of those has been provided to the South Australian government. Whilst doing that, we've also been working with them on that next process. And the next process is getting our licensing approved so that we can move to the commercial phase. And that requires us obviously doing more inputs, actually providing the government with more information. So we've been working fairly constantly with them and getting to a very, very good stage now that we're comfortable with and the South Australian government are comfortable with. In addition to that, not only do you have the practical side of running a business, we've also had to look at a strategic partner and other opportunities for the company. So you would notice that we've done a farm-in with Bridgeport. Some people were concerned that that might be disruptive or distracting to us, which is not the case. And the reason we went down that path was we would not be an operator, so that it was a very, very easy process for us to be part of. But more importantly, it actually gave us a diversified portfolio, which was incredibly important. It is always dangerous to have all your eggs in one basket. If you have them in one basket and something isn't allowed, or you have a problem with it, you don't have a business. So we've diversified with that Bridgeport joint venture.
What is the impact of COVID-19 on your business?
We've been in a bit of a difficulty in the last couple of months, obviously, because we've been negotiating largely with overseas companies, not just Chinese companies. And as a result of the virus, it meant that travel is actually impossible. It's also meant that the finance industry is sitting back waiting for the outcome, because no one knows how deep or long the impacts of the virus are going to go. So it's just slowed us down. But we are in a really good place at the moment where we're getting some great results with the government and with our strategic partners.
In your latest presentation, you talked about the economics of LCK making urea. Why are you calling this disruptive?
Look, it's a good question. When we first looked at it and we first made the ASX announcement and called it disruptive, often people would ask us exactly the same question. And the reason it's disruptive is people have been making urea for a long time. That's not the issue. The general way that you make urea is you either use natural gas and then you turn that natural gas into a synthetic gas, which has hydrogen, nitrogen, CO and methane within that gas stream, or you gasify coal. So you'll find that countries like China will gasify coal for urea production. Countries that have a high amount of natural gas use that natural gas for urea production. Where it's disruptive is the fact, if you look at the price, that no one can compete with us. And the reason for that is that as a rule, depending on the technology that's used to make urea, you use approximately 35 gigajoules of gas. So that's your input cost per tonne of urea. If you look at our competitors, they have to get 35 gigajoules of gas from somewhere. So if you're buying it in a natural gas process, everyone knows what East Coast gas prices are like. World prices aren't a lot different. If you look at American Henry Hub prices of $4 at Henry Hub, you're still looking at $6 Australian. You are still then on top of that looking at transport to Australia. So you're still looking at gas, no matter which way you look at least $8 a gigajoule. Then they have to convert that gas into synthetic gas or syngas, and that has a cost factor as well. So if we say all up that it's $10 for a company to buy their gas and to convert that gas to syngas, and they have to use 35 gigajoules of gas, that's $350 input cost for a tonne of urea. We do almost the opposite in that the gas we produce starts out as syngas, and we can produce that syngas with those different streams of gas within it for $1 a gigajoule. So we are 10 times cheaper on an input cost. So for that same 35 gigajoules of gas, it costs us $35 on input. And that's why in that release we stated that we can produce urea at less than $100 a tonne. It's not a number we came up with. ThyssenKrupp did the engineering work and the numbers for us, and they stated very clearly that we could do it under $100 a tonne. You look at our competitors, if their input cost is $350, or they can buy cheap gas out of the Middle East, they still have to transfer their urea to Australia. And as a result of that, they are looking at somewhere, depending on the exchange rate, between $300 and $350 a tonne. So no one can compete with us. So where we disrupt the market is in the fact that we can produce it so cheap, our margins are high, and if anyone wanted to go into a price war with us, they would lose.
You've also outlined in your corporate presentation that you are negotiating with strategic partners for funding the project. What is that likely to look like?
I think this is the big one for everybody. Well, I think there were big two. First was, would we get our government approvals, which we've demonstrated very clearly we can and will. The second one was, okay, you've got your approvals, you've done your demonstration plant. How are you going to raise the money to do, whether it's hydrogen production, ammonia production, or urea, and it's all in that same path line, where we're going to get the funds for that? Well, very clearly, a company our size is not going to be able to raise on our own, in certain circumstances or summaries in there, $2 billion. So we have to have a partner that has a big bank balance. So for the last year and a half, we've been negotiating with two very, very large Chinese companies, well-known companies who already do urea in China. In addition to that, our largest shareholder actually has a urea manufacturing facility in China. So they know the process very well. They know that we can do it under $100 a tonne. So we've been negotiating with them, but we've had some obstacles, and often people sit there and think that it's an excuse, and it's anything but an excuse. And the two obstacles we've had there is the deteriorating relationship between the Australian government and the Chinese government have slowed the process down. It hasn't stopped it, but what happens is that when we get to a point where we're getting very close to actually being able to put pen on paper, our Chinese partners are simply saying, look, we want to sit back. There's a lot of money we're going to be spending in Australia. We need to know that the relationship between the Australian government and the Chinese government is on a much better footing. So it just parks. It just sits there to see how that relationship's going. What's concerning about that is that you don't know whether that relationship's going to improve to a point where they're comfortable to sign off in 3 months' time or in a year's time. So to negate that, we've had to discuss with other parties outside of China, which we've been doing. We've been approached by two major fertiliser manufacturing companies, one in Europe and one in America, and we're in discussion with them literally as we speak, because we wanted to spread the risk again, that if there was an issue with a Chinese partner, if there was ultimately an issue with FIRB, that we would have an alternative, and that's what we're working through. And I might add, our Chinese partners are comfortable with us doing that to spread the risk, because they are uncertain about the same situation. How that would look is interesting. When we first started, we wanted to be able to own the gasification facility at Leigh Creek and the urea plant or the ammonia plant. But it became very clear when we were discussing it with the big strategic partners that they took this particular approach of, we've made urea plants, we've made ammonia plants, we know what we're doing and we can do them easily. You know ISG, you know gasification, you do the gasification end of the business. So if you go down that path, then you're left with a particular looking project, and that is that one of our partners will, by and large, be the majority shareholder in a urea plant or an ammonia plant, and will be a minority shareholder in that plant. Equally, we will be the majority shareholder in Leigh Creek, and they will invest in Leigh Creek as a minority shareholder in there. What that means is that Leigh Creek will then be able to make its profits from selling its gas to the ammonia urea plant, and also take the profits from the ammonia and urea plant. So that's roughly how the structure will look. There are alternatives, and there are alternatives being discussed, but that's certainly the easiest structure for a couple of the people we've been talking to in here.
There is a lot of talk on the media about hydrogen being an important part of Australia's energy mix. How is LCK positioning itself to be involved in that?
When we first started at Leigh Creek, we were well aware of the gas streams. We knew, for instance, that hydrogen was a major gas stream within that syngas. Right? And not only was it a major stream, we could actually manipulate it by simply increasing water injection, or if the coal had enough moisture in it, you could actually produce up to 50% of your gas stream in hydrogen. The problem was with that, though, that we were looking at minimising hydrogen in the production of it because there was no market in Australia for hydrogen. Right? That was 5 years ago when we started. And what we've seen is that if you have a look at it and how hydrogen is produced, right, from that gas stream that comes out of the ground, we can take the hydrogen out, and then we have a choice what we want to do with that hydrogen. We can either then move it through to ammonia and then through to urea, or we can literally just turn the tap on and take hydrogen out in an earlier part of that process. You know, we actually put up an announcement yesterday that made it very clear about the hydrogen process, what the opportunities were, the government's application and approach to it now, and the opportunities for the fossil fuel industry to be part of that hydrogen manufacturing process. The big issue for us 5 years ago was that in Australia, there was no market for it. There was a very small market for hydrogen. If you have a look at Australia compared to Japan, China, Europe, they have a semi-mature, in some cases, a mature hydrogen market. Australia has an immature market. So if we can produce unlimited amounts of hydrogen, I think we stated yesterday 200 million kilos of hydrogen per year. That is a huge amount of hydrogen. If you look at what hydrogen sells for, the numbers get quite staggering. But clearly, if you produce 200 million kilos of hydrogen, you're going to be dropping the price, which is just going to be saturating the market. So we've looked at all right, what are the alternatives with hydrogen? Is the Australian market big enough for us to actually use that as an end product? Or do we have to wait for that market to become more mature? Or do we help it mature by coming in with a partner who actually produces hydrogen vehicles, has hydrogen fuel cells, and that we encourage that market to grow so we can use our hydrogen? Or do we look at exporting hydrogen? And when you look at exporting hydrogen, it's really quite interesting, and things are changing quite rapidly. And the reason for that is that traditionally, you don't export hydrogen. Traditionally, you would export ammonia. You would take ammonia, because it's easier to transport, to a port facility. You transport it to Japan or to China, and at their receiving end, they would convert that ammonia back to hydrogen. That's been the traditional way. That's starting to change, because the hydrogen economy is starting to generate its own solutions to the problem. One of those being that there are now several programs in China on how to transport hydrogen in a pipeline. Traditionally, that has been almost impossible. You needed a carrier in that pipeline, you needed a catalyst that converts it, right? But there's been a lot of work done on that. The other area we're seeing a change in hydrogen transport is that now companies, particularly the Japanese companies, with the project in Victoria and several overseas, are now looking at transporting hydrogen in a ship specifically built to transport hydrogen. So that creates another opportunity for us. If we look at that, we either develop the Australian market, sell within the Australian market, or we look at the transport opportunities to export it. But as I said, both of those are in an early stage. I think the most important thing for us is that we can do 200 million kilos of hydrogen a year. But more importantly, if you look at the federal government stance on this, Angus Taylor, the federal minister, actually stated publicly that an aspirational price for hydrogen that he was trying to achieve by providing incentives was $2 a kilo. That's his aspirational price. If you think about that, it's pretty scary. We're already less than half of the price he wants to get it down to. So we have a competitive advantage in hydrogen that no one else has. The only issue is, what's the market for that hydrogen? Not have we got enough, not can we produce it, at what price? It's just simply, if we produce at that price, where do we sell it? And that's what we're working on. And I think that's where you're going to see some changes in the next few years. in that the hydrogen market will become more mature and there'll be opportunities to start selling into that market. As I said, we are looking at actually helping to develop that market at the moment, so that we can create demand, and therefore we've got an end use for that hydrogen.
Your share purchase plan is open to shareholders right now. Why should they invest in LCK?
I could give the standard answer that anyone you would ask that question to would be, is that because it's cheap. And what I mean by that is we believe our share price is undervalued, and we know that all companies on the ASX have taken a pretty big hit over the last couple of months due to the coronavirus and a few of the other issues that are out there and uncertainties of the market. And we're no orphan here. We've been hit as well as everyone else, but also you'll notice, anyone who reads the Fin Review or the Australian regularly will know that companies are actually out there capital raising right now. And the reason they're doing that is purely and simply because no one knows how long the economic impact of the virus is going to be or how deep it's going to go. So it's just prudent for any company to do a capital raise so that they are in a safe position and a stronger position through this process. I'd point out in addition, our whole company took a 50% pay cut just to make sure that we could preserve capital and look at our options. So we've gone to the market with an SPP. We chose an SPP or a share purchase plan for a reason, and that was that it gave our shareholders, not other investors, but our current shareholders, the opportunity to come in at a discounted rate. That was important to us. You always get criticism when you go to a capital raise. So we considered that, all right, well, a share purchase plan gave our shareholders that opportunity. I think the other thing that was really important about going to that share purchase plan was the fact that it's been underwritten by Canaccord for the tune of $1 million. That's really important. It shows credibility in the marketplace. Canaccord were comfortable in underwriting that, and we're active in that share purchase process right now. But the reason I mention Canaccord is that Canaccord is a company that is a strong one, has far-reaching tentacles, can move quickly, and we've been really impressed with how they've worked with us on this. So we've actually been fortunate enough to have Canaccord in there with us on this SPP, and we really do appreciate their support.
What is your biggest risk and concerns right now?
There's lots of little concerns. Any company has smaller concerns. If you go for what the two biggest ones are, I think the biggest risk has always been the approvals process with the government and the regulatory process. Governments by nature move slow, they're cautious, and that has been seen as our biggest risk. One of the issues our Chinese partners had was the concern over the approvals process and whether we'd get through that process. And we're very, very comfortable in saying we're happy with the progress we're making and where we're at right now. So that was one of the risks. The other risk clearly was funding. And your share price has a lot of impact on that funding, I might add too, because clearly the lower the share price, when you raise capital, the higher the dilution. Now, dilution is a funny situation where a lot of people don't like it. If the pie is bigger, you actually aren't being diluted, but it gets you to a commercial position. But being able to secure a strategic partner who has a bank balance that can take us through to the commercial production phase is the biggest risk, I think. Right? Equally, I'm comfortable on this. We are talking with partners where this amount of money is not a drop in the ocean, but it's pretty damn close to it. So as long as we can secure the strategic partner and as long as we get those approvals through with the government, then I think that the risks are just about being completely nullified. Then you have other little risks, which could become big risks in the years, things like the CO2 issues and carbon footprint, but we have a solution for that. But that's important. An ESG policy, which everyone knows is important. A lot of people don't understand why, but basically it's because those funds and investment funds around the world are now locking themselves into a position where if you don't have an ESG policy, if you don't have solutions to some of these questions, then they exclude you from their investment portfolios. And as a company, we've actually implemented that specifically from talking to the major funds, particularly in the US in the last 6 months. So if you look at your risks, there's two majors there that I think we're pretty well under control and should be able to prove very shortly that we've resolved those. And then you have those little risks that are just the normal things. How long does the virus run for? How much does it slow you down? What's your cost and capital burn each month in the company? So we're nearly through that now. When I said that Your international investment companies, your fund managers all require an ESG policy in place. It's not just a case of putting a policy in place so that you're mouthing the words of an ESG process. As a company, we seriously believe in minimising our CO2 footprint. Now, there are several reasons for that. The first is that clearly, that tipping point on this particular issue is there now, where our younger kids, where people actually take it very, very seriously as an issue, and we have to deal with it seriously as an issue. The second reason is if there is a carbon tax, then for our shareholders, it's important that we have a solution to that carbon tax. So we have, firstly, that people do care about it. It is a serious issue. It is not one that you just pay lip service to. Secondly, is it saves the company money if there is a carbon tax out there. And thirdly, we believe and know that we can have a solution to it. Right? When we know the solution sits within a couple of areas. One of those areas is offsets. Anyone can do offsets. More importantly, sequestration is probably the bigger one. There's been a lot of work done on ISG and carbon sequestration. One of the big problems with sequestering CO2 has been finding a location to put your CO2. So traditionally speaking, you'd have to inject it into a saltwater aquifer, or you'd have to inject it into rocks that are porous. You would have to get it to a pressure where it was liquefied, where it would stay within that process. It's very, very difficult to do. The other issue that's been a problem for CO2 is that if you look at a power station or you look at an industry that produces CO2, generally speaking, it's post-stack removal, which is incredibly expensive. That is, you have to take the CO2 out of the stack, and then you have to pipeline it somewhere, and you have to find somewhere to inject into the ground. It's been proven to be safe, but it's also an expensive process because you have to put a pipeline in, you have to compress and liquefy and move it. The beauty of ISG with CO2 sequestration is really fortuitous in a lot of ways, and that is that when you gasify underground, right, you end up leaving a void, right? And that void, right, because of the heat process, is actually a sealed void, and within that void, you have the ability to be able to strip the CO2 out before you use it and put it straight back in to a pre-gasifier void. Right? And the numbers are actually quite interesting here, that you can put a lot more CO2 back into that void than was generated within the void. And that makes sense if you look at CO2 being one of the gas streams. It's not all of the volume, it's not all of the gas, it's not all of the coal that was there. So a lot of work's been done in Europe on it with some universities there that I've done work with previously. And we believe that because that void sits right next to where you actually produce it, you don't have pipeline costs, you don't have issues that you have to be concerned about. You can simply re-inject it back down one of the older gasifiers. That's something we know very well that can work. And it's something I think we really have to do a fair bit of work on, because we have to have a genuine solution to any CO2 for the future.
There has been speculation online and in media about LCK making a bid which was fully funded to purchase Incitec Pivot's fertiliser business. Can you provide us with an update whether this was accurate?
Look, I'm sorry, Matt. It would be totally inappropriate for me to make any comment on that at all, other than to say we are looking at acquisitions, and that is true. And that's because we want to look at complementary businesses with us. And we've also been approached, as I said, by overseas fertiliser companies to work with us at Leigh Creek on a project up there, and also to work with them overseas. But as I said, we are looking at acquisitions, but I couldn't really comment much more than that.
Generally, as an investor, I often try and identify fundamental catalysts that will sort of drive the stock price higher in the near term and long term. If I was to invest in LCK now, what catalysts could I expect moving forward?
Yeah, thanks for that, Matt. I'm always reminded of the Demtel guy that gets up there and wants to sell something. I'm really excited. I'm really excited about, by the way, the next 6 to 12 months for Leigh Creek, because I think there's going to be some pretty amazing announcements that are made that are of substance along the lines of the approval process and the strategic partner and the funding for the project. We've got shareholders that have been in here for 5 years, and for some it seems like a long time, but we've done an awful lot of work in that 5 years. We've moved in an industry that's had headwinds against it the whole time. If you think about being in the fossil industry, and the issues within that. If you think about being in coal and the issues with that, if you think about some of the challenges that ISG have had, we've resolved all those issues, and we've worked incredibly hard to do that. But I think the next 6 months, you're going to see the fruition of a few of those things. I would hope earlier, but I'm saying in the next 6 months. The only caveat I can even give to it is none of us know where we're going to be at from the COVID point of view. And that virus, I have grandchildren that keep telling me, Granddad, there's a bit of a virus out there, just be careful. From a company point of view, you've got to be pretty damn careful with this one too, I might add. But in turn, it also gives us opportunities. You can sit there and say that it creates problems. It does. It creates timing problems in that you can't have meetings. You can't go interstate. You can't go overseas with your funders. You can't get up to China. Soon that's going to change. And the problem is every time you come back into Australia, you're going to go back into 14-day isolation. That throws the whole thing into a very slow process. Dealing with our partners over the phone is not the way to do business, I can assure you. A meeting that might normally take 1 hour, 2 hours over a Zoom conference or a telephone would take many, many more hours when I go to China, from translation, from understanding, and from dealing with each other. So that process is slowing down because of the virus. However, equally, the amount of money that's been spent in the economy by the federal government over the last few months and over the next few months creates an amazing incentive, and that is that the government needs gas. The government is talking about needing fertiliser so we're secure within Australia. It's injecting money into the economy to get it moving. And I believe it won't mean that we shortcut approval processes or grants or funding, but the opportunities for that are going to be a lot more. Governments are going to want royalties. Governments are going to want jobs. Governments are going to want projects. So, when you sit into a situation that's a bit like this at the moment where some people despair, it creates challenges, but it also creates great opportunities. And that's where I think you're going to see the moves over the next 6 months in this company. From an investment point of view, as I said, some people have been in for 5 years. We've seen that share price move up. We've seen it in the 30s. We've seen it just under the 10s, right? It's part of the vagaries of a business when you're growing, when you're raising capital, when you're getting good news, when you're under attack from different areas. That's just part of the business. What you have to do is keep your head down, keep working, make sure that you get support of your shareholders and get the project home, and just tick each box. And sometimes the next box takes 3 months or 1 day. And that's what we work through in a structured way to make sure that we've got this business to go forward.
Justin, thank you for that. That was a wonderful interview. We really appreciate your comments. We hope to have you on again soon as we hear some of your exciting progress and updates within the company.
And look, great talking to you, Matt. It's really appreciated. As I said, we have a great business. Thanks for your time. If the result of that, we end up speaking with a lot more shareholders, we could not be happier. If it reassures our current shareholders, I could not be happier. So thanks for your time, Matt.
Now, a quick look at the weekly chart for LCK. As you can see, there really hasn't been much excitement in this stock since February 2019, when there was a successful demonstration of a commercial syngas production. However, we do see the stock trading on a historic 5-year low around the 8 to 9 cent mark, and a historical support level on the long-term chart. Volumes are starting to build, and a flag pattern formulating with a recent double bottom would suggest that LCK is trading on its low and could be a good level to get exposure. Thank you, viewers, for watching this interview today. It was a little longer than usual. However, I think you would agree every word was worth listening to today. May we also remind you to ensure to read the disclaimer at the end of the presentation. The information provided does not constitute financial advice. Consult a financial professional before making any investment decisions. Thanking you.